Welcome to the show we like to call For the Love of Real Estate, where we dive into what it means to buy or sell a home in today's world. Join host Jill Elliott, Dallas broker associate and former radio personality, as she marries her two loves, radio and real estate. She's going to have you asking yourself, for the love of real estate, should I tackle my fears and buy, rent, sell, or remodel?
Hello and welcome to For the Love of Real Estate, where we talk about any and all things related to real estate. And of course, a hot topic, we can't seem to get away with it as we head into 2023, is still interest rates, which I don't know if I ever told you this, Brooks Kelly, but I said I would never do a show on interest rates, and I already have, because I thought it was too boring, but yet here we are. So I wanted to really round out this new year with one of the best people I know, Brooks Kelly. You are the EVP of Sales and a Senior Loan Officer with the Mortgage Link in the DFW area and beyond. Welcome to the show.
Thanks for having me, Jill. I appreciate it.
Hey, no problem. You know, one of my things that I like to do is have people on my show that I find interesting. I know, right? But I find interesting that I feel like it really helped me and that can help other people too. Because I want this show to be more about not what I've done, not what you've done, but how we can help somebody else in their journey. Because I think what we're finding out right now is the way that interest rates are, this is really more of a journey than a sprint than it's ever been, right?
Absolutely. Yeah, I think everybody is looking towards us for information more so than I think I ever have in my 16 years in the business. So. Right.
And so that being said, you've been in a long time. And it was funny because we were texting the other day about what to talk about. And I said, you know, I wanted to talk to make this a little bit different. I want to talk about the buying power for people who are in that higher price range, who are saying, you know what, I think I want to move up, but I'm not sure how to do it because there are so many factors and so many moving parts. And then later that day, they actually changed the amounts, right? To go from that jumbo loan status, which really is a harder loan to get. Isn't that correct?
Yeah. So they change the conforming loan limits every year. They were stagnant for a long time, and they've increased ever since the 08, 09 crash. They've gone up a little bit every year, but the last couple of years, and this year, they've gone up from 647 to 726, which is a significant increase, but It gives a lot more options and buying power to people that are looking in that, $700,000, $900,000 purchase price range.
Right. So let's talk about that, options. Let's talk about what that means. So if someone comes to you and says, okay, this is how much I have to put down, I want to find a house, I want to move on, but how can I get there without having, just the, I guess, really that jumbo loan thing? I almost went through it and it's never fun. But this really, I think, is going to help people move to that next level when they didn't think that maybe they could.
Yeah, absolutely. It opens up opportunities for much lower down payment options. A conforming loan or a conventional loan is a much easier loan to qualify for than a jumbo, because when you cross that 726 line now, it goes into private money or jumbo loans that each and every bank or bank partner we have makes their own rules for. But typically it's 15 or 20% down. It's 700 plus credit scores. It's much lower, qualifying ratios that go into that too. So as you go into the conventional loans, it's more streamlined, that we have automated underwriting. We know it's more predictable, from loan to loan, and you can do it with as little as 3% down if you're a first-time home buyer.
I know, and that is just crazy, isn't it? Slightly. I mean, I know everything changes, but to tell somebody that you can actually do 3% down, because to this day, how many people still probably say, I know, but I don't have 20% down. And it's like, whoa, back it up. You don't need 20% down anymore.
Yep. Yeah. So, it's still a common misconception. I don't know why that is, or, people think that MI or mortgage insurance is a bad thing, but it's really not. It's a great thing. It's a vehicle for you to purchase a home without having to save, $50,000, $100,000 to put down on a house, which could take a decade for a lot of people to save that much money, Get in the race now, let the equity build and use the MI as a vehicle in order to do that with 5% down on a $750,000 home.
Well, because on a conventional loan, I mean, the MI eventually falls off, right? Depending on the payment, what you pay on it. And because I actually had somebody tell me that I worked with a few years ago, they said it just fell off, because what happened was their appreciation went up, right? And then they were able to refi or whatever they did, right? So there's so many options. And I think that's what's so crazy right now is people just think, oh no, high interest rates, but they're really not that high. If you go back into our world, probably when I bought my first house in 1990, I think, great credit, 10% interest rate. 10.1 to be exact. So really these aren't that bad. And this is what I think people don't understand is that that also is good for your tax write-offs too, right?
Yeah, all the interest and tax expenses are a write-off. Yeah, but right. Historically looking at interest rates, I bought my first house in 2005 and rates were 6%. I didn't think twice. I think it's just an adjustment period for people who have seen over the recent history that rates are, in the 2s and 3s and 4s, and so it just takes a little bit of time to adjust. It also takes the market a little bit to realize that home prices can't go up 15 or 20% per year. That has to subside a little bit, which it already has. So,
yeah, and I think that besides the fact you just told me how much older I am than you. That's okay, Brooks. That's okay. But I think it also, I think what that does is that just sort of gives people a better perspective of what they need to do, because everybody's just thinking, no, I can't. But yeah, you can. And I love to talk about this, especially with my buyers. If you rent for $2,600 a month and you do that for 5 years, it's about $156,000. So you just paid somebody else's mortgage for $156,000.
Yeah, not only that, you missed out on 15 or 20% appreciation too. So
right,
they're taking all that equity and you're not. You're paying down their mortgage, they're getting the equity, and you're left with another rent payment.
Right, exactly. And you can't draw from that. You can't say, oh, I have equity in my house, so now when I move on, it's like leasing a car, right? You go back to turn that lease in and it's like, okay, so I get nothing. I have to give you the money. So I think it's really important for people, if you can buy, look into it. And something else I was thinking about too, I also want to talk about people who are choosing not to sell because they don't want to lose their current interest rate. So they don't want to sell their house. However, if they have some equity in their home, they're going to get one heck of a deal on a buy side. And I preach this all the time. You're never going to get, pay a seller $100,000 over, or if you're selling your home, get $100,000 over and turn around and then go to as Mr. Buyer and go to that seller and say, I want $100,000 less. We have to have a system that checks and balances itself.
Absolutely. Yeah. You can't just base your buying decision on the interest rate. It does affect your monthly payment, but if you look at, the picture from take a step back and look at the entire picture and not just what the interest rate is, there's a lot of opportunity in the market to sell. If you bought this home 3, 4, 5, 10 years ago, the equity that you built, enrolling that into the next purchase or using some of that to pay off some consumer debt that you put up and only put 5 or 10% down on your next purchase. There's an opportunity that we have today in the market that we didn't have, in the spring when it was just hyper competitive and people were paying $50,000 or $100,000 over the list price. Now, like you said, there's negotiation, there's seller paid closing costs, or they'll help you with buy downs or even lower sales prices or whatever it is to help, facilitate that purchase.
Yeah, and I want to talk a little bit about that. Let's just do a typical buy down. So somebody comes to you and they say, man, I don't know about this. And when you talk about buy downs, what does that mean? And what kind of there's lender incentives and things like that that I think lenders do now that they didn't do before.
Yeah, well, there's permanent buy downs and there's temporary buy downs. Permanent buy downs, will lower the interest rate 1/4 to 0.5%, depending on the day, for permanently for the 30 years of the loan. But it incrementally on your payment, it's not significant. It's $50, $100, $150 a month. But most likely, you're not going to be in that loan for 30 years. So you have to make sure that your break even is there what's become more common and has been there for years and just not used since the last time rates were in the 6 and 7s is the temporary buy downs, or the 2-1 buy down, which will buy your interest rate down an entire 2% for 1 year, 1% for the second year, and then it goes to the fixed rate that you locked in for the remaining term of the loan. But that's a significant change in your monthly payment for that 2-year period. And the forecast from Fannie Mae is that they say interest rates will go back down in the next 6 to 18 months to the 4.5-5% range. So you're going to be refinancing that loan anyway. So why would you pay for a permanent buy down if you can get a better effect out of the temporary one?
Oh, there you go. There you go. That's kind of the key. So some people might go, oh no, I want that permanent one, but there could be that incentive to think of it other. I didn't know that there were permanent and the other ways. I feel like that's just one of the many options, right? And I think this is important to know for people, that the bottom line is that interest rates are also determined by you, the individual, right? So what are the obvious? Yeah. So people are going, there is no way I'm not doing that. Then what are some things that they can do? Like if you quote them, hey, you're the average. Hey, DTI, second jobs. A lot of people have a side hustle these days. So how can you work all of that into it? They have to lay it all out on the table for you of what they have and what they don't, right? I mean, and then you can take those things, because I think that if right now would be the time, if I thought I wanted to buy into the next year, I want to know, from a qualified lender, well, what do I need to do to make my interest rate better? Because when people were doing 2%, 3% interest rates, not everybody got those. They thought they did, but not everybody did. They may have gotten 4 and were happy, right?
Absolutely, yeah. I mean, it's all about the buyer, and really the most the driving indicator of rate mostly is credit score. So making sure that your credit score is 700 or above is a significant difference between below. So conventional loans adjust every 20 points of your credit score, and so that will significantly affect what interest rate you get. And it could be, anywhere, it could be a full percent different if you're a 620 versus a 720. So keeping your credit up and learning that process as a consumer is necessary. It's not a popular thing like credit. A lot of people don't like credit, but it's part of our society. It's buying a car, a house, getting a credit card, whatever. You have to play that game. And the better credit score you have, the more on-time payments you have, the better you play that game, the better interest rates you're going to get, no matter what consumer item you're purchasing. So that's something really to be mindful of. And then your down payment does affect it and what loan program you're on. But it's not a significant change on your down payment, really. I mean, you get pretty much the same rate if you put 5% or 20% down. It's not a whole lot different. So
right, exactly. At one point, like let's just say, I'm going to put down an extra $50,000 on my, 30-year mortgage. Well, that might be better for you to hang on to and do some fixes or things like that, because your payment is probably not going to change. That's not going to may not change your interest rate either. So I think it's more important to have that $50,000, let's use round numbers, in a bank somewhere. If I can put down 100, I'm going to use round numbers. I can put down 100 or 150, and my payment's going to only change what, $30, $40 maybe on something like that. It's not going to change that much.
For every $1,000 finance, it's about $5 a month. So $50,000 is $250 a month. But if you're but $250 a month at $50,000, even making 5% in the stock market makes a lot more than $250 a month. So your house is appreciating anyway. No matter how much money you put down on it, that asset is appreciating, and you're going to get better return on investment by putting minimal down in the house and then using those funds either for home improvements or to actually invest in the stock market or in other opportunities or even an investment property, to get double the appreciation.
Exactly.
So if you can put 5% down on your primary residence and then, save up your 20% to buy an investment property or something like that, then you get double the return on investment there. So we educate our clients as we go through that process to help them understand that additional 10 or 20 or 30,000 they want to put down is not really necessary. And buying a home, you have expenses going into it. You want to put new furniture or redo the countertops or moving expenses or whatever that is.
Because let's face it, again, I can only speak. I'm licensed in Texas, but I can tell you what, the good ones though, folks still go fast. So if you are that person that did the updates as you went along, and your house is great shape, whatever it is that you did, you still might have to pay over for those. I mean, they might be sitting, they might not. But I think that's what sort of a lot of people, their expectation, they feel like their expectation should be higher right now. You know what I mean? Well, but I'm paying this amount of money, and I should be getting this, but not always the case. However, sometimes you do. Sometimes you do walk into that house, and still those are the ones I think that you might have to pay over on if you do. Now, could they appraise and you don't have to bring anything out of pocket? Yeah, they could, right? Did a house in Carrollton that way. They was 115 over list, and gosh darn it, the thing appraised. Now, they priced it lower. They really did. If you looked at the comps, they priced it lower because they wanted people to go over. But just in something to keep in mind, when you see that perfect house with every single solitary thing in it that you've ever wanted, chances are there are other people, because we still have we have low inventory here. It is low, but then to me, it's kind of not, because I think that, like I said, your expectation should be there. It shouldn't. You have to start looking at houses and say, yeah, these are the same price. Look what they did. Look at this. Oh, but where's the location too? Which also brings me to that point of, the high cost areas, right? So how does that work? Because some limits are this or that. So in some, it's like standards and high costs. Are we considered like a high cost area? How does all of that? How does that work for DFW or for anywhere to ask your lender?
Yeah, there aren't any high cost areas in Texas actually at all. Most of those, and there should be. I think there's some,
no kidding.
Definitely Highland Park, that's a high cost area.
There.
Yeah.
Let's face it.
So there should be pockets of that in Texas, but overall, you see most of those in L.A., New York. Some of those, San Francisco for sure. And you get higher loan limits through the conventional loan limits when you're in a high cost area. So
I got you.
They allow for, it's even over $1 million in some areas now that they'll loan conventional up to. So
yeah, but still, somebody again has more buying power out there with these changes than they thought that they did, right? Like, don't you think that was almost like life changing?
Yeah, I talk to so many people when they qualify with us that they don't think they can qualify at all, and then we show them what they can, and it's crazy what they can qualify for and what they want to too, like they might want a $3,000 a month payment, and then you show them they can qualify for a $600,000 home, which those two things don't go together. So really talking to a professional and an expert and understanding who you are, because everybody's different. Every scenario is different.
Sure.
Every income, scenario is different. And just understand there's no cost to it. It's a free consultation, and understanding their future and what they need to do to save, to plan, to get ready to purchase. We've seen a lot more of that in the last 3 months than we did in the last couple of years. Everybody was very hyper to get into a home tomorrow for the last couple of years, and now we're seeing it go back to pre-COVID, where people are saying, okay, I'm in a lease till May. I want to explore my buying opportunities at that point, and I want to have a plan in place to see what we need to save and what my monthly payments look like, and what, then they'll start softly searching areas with their real estate agent to understand, okay, this is the payment I want, and this is the house price I'm looking at, so that they can plan better for the future. It's not so hyper, I want to qualify today and buy tomorrow.
Yes, exactly. And, and also when I think about coming up in 2023, let me ask you this. We don't really know at the moment what that's going to bring with these interest rates. Remember, I know when I first started in real estate, there wasn't much of a spring, summer, winter difference for the first couple of years before that big boom hit, because you just sold the house when you were ready to sell the house, right? So we don't really know with these interest rates what this spring is going to be like. Is it going to be halfway crazier than it was last year or this past, spring market? I'm going to find it very interesting to see. It's almost like I'm really looking forward to it in my geeky way, that I want to see what this means, because things are so cyclical, right? About 10 years or so when everything was going crazy. And then, but before that, if you were in it for, and a lot of people have been, that I was like, what just happened? And then it kept getting more interesting in the last 10 years, and all of a sudden it sort of took this dive. So will we see lower interest rates by March? Will we see it leveling out? I mean, just from something maybe in your own, as long as you've been doing this, do you see it like an every 10-year change or what?
No, it's definitely not that long of a cycle, I do think that as we go into the spring that you'll see a leveling of interest rates. We've seen them come down just a little bit in the last few weeks or so. I think, the Fed in their federal funds rate increases will continue. At least for the next two Fed meetings, they'll increase the federal funds rate another 0.5% at both meetings. And that doesn't necessarily directly impact interest rates, because that's the short-term borrowing rate, but it does impact the overall investors and how they look at it. So I believe that rates will stagnate somewhere where they're at in the 6 to 7 range for the next few months until they feel like inflation's in line. And I think inflation is in line, because when they calculate the consumer price index, the CPI number, which is what they really look at for inflation, is they're comparing this December versus last December.
Right.
And we saw starting in September, October this year is when the numbers started to level out or even go down. So as we go further along, we'll continue to see it go down. Gas prices have gone down. Hopefully diesel goes down. So consumer products that are being delivered go down. And I think as the year goes on, the Fed has done their job. I think they've actually accomplished what they were looking to do. And so I think as that goes on, we'll continue to see rates ever so slightly decline as the year goes on, and we'll hit those targets that Fannie Mae was talking about. So I don't believe that waiting for interest rates to go down is the right thing to do for anyone. 70% of the loans that we did in the last 2 years were refinances. So people were already in the house that they wanted to be in, and then they took the opportunity to refinance when they're in there. The hyper competitive market that we went through in the spring of this year was because we were telling people for 2 years, rates are going to go up. You need to buy now. Well, if they waited or they couldn't buy a home, they started to see the rates go up January 4th of this year. And they just continued to go up, and it just made everybody hyper competitive. So if you wait for them to come down, you're going to be back in line with everybody else that, has been waiting for that perfect opportunity to come. So
right, and it really has to be when it's right for you, and it can't be, like you said, and not just that perfect opportunity, but when it's right for you. I mean, I remember my husband keep asking me, let's move, a few years ago, and I'm like, have you met me? I'm a real estate agent, okay? And one day I just sat up, I was like, it's time, and know when it's right in your world. And this is going to be that time where probably in 2 years, if you do have to sell it, it's going to level out. Like, it's not going to be that huge boom of, certain houses in certain areas that went up so much in value, so quickly. I don't think, like you said earlier, I don't think that home values are just going to go up as quickly. You will have to live in this house a little bit more. But unfortunately, and we see this, somebody buys a house and they have to move in a year or two because they're being transferred, because they have to move, and then they're just all bummed out about it. It's like, no, do what you got to do and go on and get your deal on the other side at this point, is the way I say it. Because it's about you and everybody. When you see the media and you see all of this information out there, it could be on a national level, it could be on a whole different, I guess, just level of what they're trying to tell you, and it's almost scary. And I'm thinking, wait a minute, for all of us that are in it, it's really not that scary, but it is. I think it does scare people, don't you?
Yeah, fear always sells, doesn't it? You watch the news, and the only thing that's on it is, all the bad things that are happening in the world. So, yeah, for everybody that's on the ground day to day, like we are, there's still lots of people buying houses. We've, qualified a half a dozen people already this week that are looking to buy homes. So, the market doesn't stop. In bad years, we still still, millions of people buy and sell homes in bad years.
Well, shelter. It's all about shelter. And I think when we brought in that aspect, and for those of us who can remember when it was just about shelter, it wasn't about your investment. It wasn't an investment to be in real estate. So you probably kept that shag carpet a long time, right? Okay. But it is an investment. But you have to, and so many people say date the rate, right? I don't know. I say date your house. I say make your house, be just in love with your house. So, I love you. Instead of I'm not going to buy shoes, I'm going to buy those granite countertops. That kind of stuff. If you have to make a choice, right? Because this is your investment, and rates will change, but you still have that house. See? So that's why I say, fall in love with your house and date your house. Be up for that. And just in looking on my little list, is like, okay, you spent, and a lot of people are right now. And I know they say rents are going down, but don't let that say, oh yeah, now I should rent. No, what it is, it's like $3,000 a month. Let's see, in 25 years, you'll buy that guy a $900,000 house. And if you do it 30 years, you bought him $1 million home. How is that?
Yeah.
So really understand, and if you need someone to talk to you about it, talk to Brooks Kelly and his team, because you guys have helped me out of a lot of issues with my buyers who were with someone else and then came to you, right? So that's what I would recommend. Yeah, and he said that word in there, and they educate you. Right. So I think that's important. And Brooks, it's always just such a joy to talk to you. And you're so knowledgeable about this. You have 1 million YouTube videos that I've watched and things like that. I mean, you're always on it. And I think that's just the big thing. You're on the pulse of it. So that's amazing. So one way, Brooks Kelly, what's the best way for them to get in touch with you?
The easiest is just go to brookskelly.com. It's got all my contact info, my YouTube, Instagram, all that stuff. If you want to watch those videos you're talking about and just learn more about it from that standpoint, we try to keep everyone up to date and how the market's doing and what we're seeing in the market, so you don't have to rely on your local news for their doom and gloom. We can tell you what's really happening. So that's the power of social media, I think, is really for the truth to come out, in some way where, we're really talking about what's pertains to you as a client. And then from there, you can do an application, or you can just contact me and we'll set up a consultation, talk about you personally and what your situation brings and how we can set those goals for you to buy a home.
And we'll make it a great 2023, because I'm kind of wrapping up. If you're listening to this at some weird time or something, we're all wrapping up the year to make the next one just even better. More knowledge is what we're all about, and helping our clients and bringing that value. And you definitely do, Brooks.
Well, thank you.
I'm always a joy to work with you and talk with you. And I want to say thank you again. I hope you've enjoyed this episode of For the Love of Real Estate. And if you could, be a great Christmas gift for actually me and Brooks if you download this show, because then you can just listen to him over and over again. How about that? Right? And you can understand what's going on in the mortgage world in the DFW area, or just about anywhere.
That's right. Well, thanks for having me, Jill. It's a pleasure always speaking with you, and we look forward to the next time we can be on your show.
I would love it. I would love it. And thanks, everyone, for joining us on For the Love of Real Estate.
Thank you for tuning into For the Love of Real Estate. If you enjoyed today's show, head over to fortheloveofrealestate.biz to join the conversation, access the show notes, and sign up for our newsletter.